Let's take a look at the balance sheet. And the balance sheet can sometimes seem confusing, but it's really more about logic than anything else. Here's the overall idea. What do you own and how did you get it? So the balance sheet shows what the company owns in terms of assets and how the company got those assets. And assets are paid for or funded by credit extended by either suppliers or lenders, those are liabilities, or by the owners of the company, and that's stockholders' equity. And the balance sheet shows where the company is at a specific point in time. It shows the financial position on the date noted. It does not show how the company got to that position or where it might be headed into the future. It's really a snapshot at a point in time. Let's take a look at a sample balance sheet. Assets can be grouped into current assets and longer-term fixed assets. And current assets are assets that you expect to turn into cash within a year. And cash falls into that, obviously. And contract billing that's in process, along with accounts receivable, which is AR, are also assets because you expect to collect or to turn them into cash within a year. Also, inventories that you have on hand, you're hoping to sell those within a year. You don't want those inventories sitting around for the long term. But some assets are longer term, and we call them fixed assets because they don't change in the short term over a year. Things like a plant or equipment, things like that. And goodwill is a longer term asset too. And goodwill is actually an intangible asset, and the definition of goodwill from an accounting standpoint is the excess above book value that a company has paid for the purchase of another company that they acquired. Mergers and acquisitions is something that happens a lot in the A&D space. And assets are balanced by, as we've said, and have to equal liabilities plus equity. And liabilities can again be current liabilities or longer term liabilities. And current liabilities are those that you expect to pay off within a year, such as notes payable, which is short-term debt that's due within a year, and advance payments. This is what customers have prepaid for a program, so it's a liability as you haven't yet provided the product or the service. And accounts payable are bills that need to be paid within a year, and accrued expenses are liabilities that are estimated by the company to be due based on the consumption of something over the year, such as a power bill. And then you've got longer-term liabilities, such as accrued retiree benefits, which are in a pension plan that you would need to actually pay out at some point in the future, and long-term debt that's longer than a year. And finally, stockholders' equity. Common stock and additional paid-in capital is what investors have put into the company. It's capital they've provided to the company. And retained earnings is also under equity. These are profits, as we discussed earlier on the income statement, that you've retained in the company as opposed to paying them out as a dividend or a distribution. And retained earnings itself could be represented and balanced on the asset side by cash if you're holding some of those profits in cash. Or maybe you bought a machine or a building with the money that you've retained as opposed to paying it out as a dividend. And so just following logic again, total assets have to equal liabilities plus equity. And some questions you can answer by analyzing the balance sheet include things like, how much cash do we have to cover our short-term current liabilities? How quickly are our customers paying us? How much product are we sitting on and haven't yet sold? That's inventory. How much do we owe our suppliers? That's accounts payable. How in debt are we? How much money have the shareholders put into the business? That's common stock, along with additional paid-in capital, and also retained earnings, what the owners have put back into the company instead of taking that dividend.